Is 3M stock a smart buy right now? That's the big question we're tackling today. Welcome to Global Value, and in this video, we're going to dive deep into a thorough analysis of 3M, stock ticker MMM, emulating none other than Warren Buffett, one of the greatest investors of all time. We'll look at the key numbers that Buffett values most, and then we'll calculate 3 different fair values for 3M to really understand what it's worth in today's market. Make sure you watch with me till the end because our combined fair value and rating might just take you by surprise. And there's more. I'll also reveal a crucial bonus metric that could be the deciding factor when adding 3M stock to your portfolio. So is 3M a golden opportunity waiting to be seized? Let's figure out together. Right now, 3M stock trades for $106.25 per share. 2023 has been rough on the company. Their stock price is down 13.5%, while the S&P 500 is up more than 20%. 3M's underperformed the market. This even comes with the company's huge 5.67% dividend yield, and 3M's a dividend king. They've grown their dividends each year for the last 65 years. That's an insane track record, yet they still don't beat the market this year. In the last 5 years, their stock price is down 46% overall. This comes as the company has faced some major legal battles related to previous products. In the last decade, their stock price is down 23%. And when we go back before the global financial crisis, in the last 2 decades, their stock price has only compounded at 1% annually. 3M really started diverging from the market in 2019. Until then, with their dividends reinvested, they would have beat the market over this time. But that's not the case today. 3M trades $23 below their 52-week high. This comes as they trade $21 above their 52-week low, and they have around 2% of their shares sold short. But how big is 3M? They're still huge. They have a $58.5 billion market cap, plus they use some debt in their business, so they have a $70 billion enterprise value. But the burning question is, why should we be paying close attention to 3M? 3M is a multinational conglomerate that's operated since 1902 when it was known as Minnesota Mining and Manufacturing. The company is well known for its research and development laboratory, and it leverages its science and technology across multiple product categories. As of 2020, 3M is organized into 4 business segments: safety and industrial, transportation and electronics, healthcare, and consumer. Nearly 50% of the company's sales come from outside the Americas, with the safety and industrial segment constituting most of their net sales. Many of the company's 60,000 plus products touch and concern a variety of consumers and end markets. In 2023, 3M settled some big lawsuits. They reached a $10.3 billion settlement in Forever Chemicals, along with some leading chemical companies in the United States. They'll pay out this $10 billion over 13 years, but they did not omit any liability. Separately, 3M also agreed to pay out $6 billion to U.S. military veterans and service members who suffered hearing loss after using the company's earplugs. These 2 settlements combined are a $16 billion hit to a $54 billion company. That's huge. With those lawsuits settled, can 3M try to reclaim its former glory and go back to beating the market like this storied dividend king has once done? We're going to find out by looking at the company like Warren Buffett. So let's get started with our first metric. We want their average return on capital in the last 5 years to be above 14%. A normal business earns 7% returns on capital, and when we look for a benchmark that's double this, we can build in margin of safety based on the quality of 3M's business. Their returns on capital have declined over this time. They were pretty lumpy in both 2018 and in 2022. In these other years, they were more steady around 20%. Still, when they're averaged out, 3M earns 22% returns on capital in a given year. This is 3 times better than a normal business, meaning it's a huge check on metric number 1. In metric number 2, we want growth in their sales, earnings, and free cash flows. We'll include their numbers up until today. In that time, their sales are about flat. They're just very slightly down, but down less than even 1%. Their earnings were hit by their legal settlements. Otherwise, they're actually up. But most importantly for the business, their free cash flows are flat. They're very slightly down, pretty much matching their revenues over this time, again when we look at their numbers up until today. Free cash flow is the lifeblood of any business, and we'll find 3 different ways to value 3M based on those later in our video, so stay tuned. Because of these, all 3 of them are technically down. It's an X on metric number 2. In metric number 3, we want them to be growing their earnings per share. This was the case going into 2022. In their last 12 months, the company's lost more than $13 per share because of their legal settlements. If these were to be excluded, their earnings per share would have been up because at the same time that they've grown their earnings otherwise, 3M has actually bought back 8% of their shares outstanding. This comes at a time when they both trailed the market and when this Dividend King is returning a ton of capital to shareholders. They have these pretty steady buybacks and a history of growing their dividends, which again puts more money into shareholders' hands. Still, because they had those legal settlements in 2023, it's an X on metric number 3. In metric number 4, we see the power of their share buybacks. We want their free cash flows per share to be growing. Even though their free cash flows are about flat, 3M has bought back 8% of their shares, which actually means their free cash flow per share has grown. In their last 12 months, they earned $8.77 per share. This was up from where they ended 2022 with just $6.79 per share. It's a check on metric number 4. So far, we're split evenly. We have 2 checks and 2 X's. Before we look at the company's debt and find out how much they're worth, why don't we check in on our bonus? Right now, 3M pays a huge 5.67% dividend yield that beats the market. They've even grown their dividends for 65 straight years, making them a dividend king. But are their dividends covered by their free cash flows? That's what we're trying to figure out in our bonus because it can tell us if this is going to be sustainable into the future or not. 3M's cash flows per share have grown because of their share buybacks in the last 5 years. In this time, they've supported their dividends and their dividend growth in all 5 years. That's even the case in 2022, where their free cash flows were down and their dividends have grown. 3M isn't growing their dividends by a lot, but they are supporting these, which is what we want to see. That's also the case today. It's a check on our bonus. During recessions, it's businesses with too much debt that can have the biggest losses and even go bankrupt. In metric number 5, we want their net debt to be below the sum of their free cash flows in their last 5 years. Net debt is a company's debt minus its cash and its short-term investments. 3M upped their debt from 2018 until 2019. Since that time, they've been paying this off. They ended 2022 with $13 billion in net debt. Today, they have $11.7 billion worth. In their last 5 years, 3M has brought in $21.3 billion of free cash flow. This is enough to support their net debt position. It doesn't look like 3M is using that much leverage in their business compared to their free cash flows. This is exactly what we want to see, meaning it's a check on metric number 5. Now, how much is 3M worth? That's what we're trying to figure out in the big metric of them all. We want their average 5-year free cash flow divided by their enterprise value to give us a yield that's above 5%. If it's the case, it gives a starting point for a reasonable valuation of 3M. Right now, 3M has a $70 billion enterprise value, which is what we get when we add their market cap and their net debt together. In the last 5 years, they brought in $21.3 billion of free cash flow, which means that in an average year, they bring in around $4.26 billion. When that's divided by their $70 billion enterprise value, it gives us a 6% average free cash flow yield. That's above what we're looking for. Plus, currently, 3M brought in $4.85 billion of free cash flow in their last 12 months. This means it gives us a current 6.8% current free cash flow yield. Right now, that means it gives a 6.8% current free cash flow yield, also above what we're looking for. Coming in both today and historically, this is above what we want to see. It's a check on metric number 6. Don't just run out and go buy the business. Even though 3M goes 4 for 6 on our analysis, we still need to figure out what they're worth using our 2 other methods. Plus, our final value and rating at the end may take you by surprise. Everything we've covered so far is important, but there's something missing. This, in my opinion, is the main reason to analyze 3M. Here we'll use a discounted cash flow valuation to estimate their fair value per share. This is based on their business predictability and their free cash flows going out into the future. Like any other model, these outputs are sensitive to its inputs. 3M's been moderately predictable in their last decade, even despite these recent legal settlements. That gives a decent amount of predictability to this model, but it's still up to you to figure out if these are accurate or not for 3M. We'll take an average of their last 3 fiscal years worth of free cash flow, then use historical assumptions to grow these into the future. If we assume they grow their average free cash flows by 6% in each of the next 10 years, then in the next decade, we'll assume these grow at 4% annually. If we want a market-beating 15% rate of return, which is what Warren Buffett looks for from his investments, at today's valuation multiples, it looks like an estimate for 3M's fair value per share is only around $73. Please keep in mind some key points. This doesn't include the company's huge dividend yield. Also, 3M trades toward the low end of their valuations in the last decade. Right now, they trade for 14 times enterprise to free cash flow, when this has ranged from 12 times all the way up to 36 times in just the last decade. Their median valuation is around 21 times, so this says they're about a third undervalued compared to that. We'll also use a guru-focused value for 3M. This is based on their business predictability and analyst estimates for the future. It also accounts for where they've traded compared to their past. Right now, this puts 3M's fair value at around $140 per share with a modestly undervalued rating. 3M also looks close on our valuation chart, but they're off when it comes to their net assets and their tangible book. Both of these are negative. In part, that has to do with the accounting for the business, especially giving their share buybacks. Some of this may be distorted for the company and may not be as accurate as it looks here. That's up to you to dig into their filings to learn more about. So far, we've covered most of the numbers Warren Buffett really cares about, but it's the qualities of a business that are most important to him. Why don't we learn what these are for 3M? We're going to start with a long thesis first. Number 1, 3M continues to emphasize innovation and keeps competitors away with generous levels of R&D spending, which typically totals nearly 6% of net sales. Number 2, the firm continues to benefit from its shared technology platforms, which are applicable to multi-use cases. Technology allows 3M to charge a 10 to 30% premium for its products, but also brings down its unit costs. Number 3, 3M is likely to profit from repositioning its portfolio to faster growing portions of global GDP, which over the long term should allow it to handily outperform industrial peers. But we need to look at the negatives for the business as well. Let's check out a short thesis. Number 1, while 3M has earned returns that have been double its cost of capital for more than 25 years prior to the pandemic, gross profits over prior year R&D spending have started to slow down. Number 2, the firm faces several challenges, including slowing respirator sales that represent an approximately $500 million sales headwind in 2023 alone. Number 3, litigation risks may continue to cripple the value of the company and remove any benefit from potential fundamental catalysts. Now let's combine 3M's business qualities with their numbers as we estimate their fair value and give our final rating. Now it's the moment you've been waiting for. This far in our stock analysis of 3M, stock ticker MMM, we've learned that this company goes 4 for 6 on our Select 6 analysis. Not only do they earn high returns, it looks like they might be trading for reasonable multiples that may be attractive compared to their past. At the same time, 3M's returning a ton of capital to shareholders with nearly a 5.7% dividend yield and plenty of share buybacks. But it comes at the same time when the company's growth may have plateaued. Their sales and free cash flows are slightly down but pretty much flat, and their big legal settlements reached in 2023 really distort their earnings, which are otherwise up. Still, despite this flattening of their growth, 3M manages to support all their capital returns to shareholders. When we combine our 3 estimates of 3M's fair value and their business qualities, we get a fair intrinsic value for the company around $113 per share. Remember, fair values a range on either side of that number, but that's around $7 above today's stock price. It's also up $2 from the street's target price. It's better to be roughly right than exactly wrong, and today 3M looks like it's about fairly valued. This analysis isn't financial advice, and it's not a buy or sell recommendation of any security. Use common sense and do what's right for your own situation. If you enjoyed today's 3M stock analysis, like the video, share your thoughts in the comments, and watch this next video. You may enjoy it.